So let's look now at how we would manage a bear flag. Well, we take profits on half of the stake when the stock moves down by 0.382 or half of the initial flagpole thrust. So in practical terms, what that means is if we sold short 100 shares initially, what we would then do is buy back 50 shares at the first profit target. What we then do is we would move our initial stop loss down to near break even and then use a falling trend line, a descending trend line, as our trailing stop as the stock falls in price, and therefore we can get some windfall profit hopefully when that happens. So let's look at an example here. We're going to short 100 shares. The stock price has dropped by $4 before making a bear flag, say. There's our entry point with the yellow line. We put our stop in just above the flag area, and as the trade is entered, we short 100 shares. We then buy back 50. We close out half of the position as our first profit target is hit. And then what we do is we lower our stop. See the color of that change? We lower our stop so that if the share price were to reverse back on us, our second half of the trade is protected and we've walked away with a profit on the first half of our trade. And hopefully what happens instead is the stock continues to go down, and we can then manage that with a trend line that we can then adjust. Because if the stock then forms new bear flags on the way down, we would like to participate in those with the original trade and even get into new trades with new bear flags as well. So this is where we make windfall profits. When the markets trend heavily in one direction or another, we make huge profits. There's no quicker way of making money in trading than when the markets are trending, and these trade setups are geared for us to take advantage of those situations. Now, in the meantime, if the markets aren't going to trend, we need to still be able to pick off some profits as we go along and do better than tread water, we hope. So let's have a look and see what happens if our first profit target isn't hit when we're shorting. Well, here's what happens. Let's say that's our stock and it's made a retracement after its big move down. We've got our three lines there, which we're getting used to now. Our entry line short would be the yellow line. Our stop, or our initial stop, is the magenta line, and our first profit target is the turquoise line. Now, of course, what we can do, if the stock does that, we can lower our initial stop loss so that we absorb less risk on the trade. And we do that if we're a bit unsure of the markets or if the markets are a little bit choppy. So let's just say the stock goes down, hits our entry point with the yellow line, and then doesn't quite reach our first profit target, starts to waver a bit. We could have lowered that stop loss point, and the stock, if it reverses back into the flag, then we are stopped out. Now again, just like before, if we're going to do that, then we're going to get stopped out more often. There's a greater risk of that, but at least those stops will be tiny in terms of the risk. If we were to retain our stop loss above the flag here, then we do take on more risk if it's hit, but the chances of that being hit are far less. So again, you pay your money, you take your choice. You've got to look at what the market's doing, look out for what the OVI is doing as well, and make a judgment on that.